Ringy presents.
Pulse of the sales industry. Stay ahead of the game. Latest news, latest trends. Nothing ever stays the same. Market shifting every day. Gotta know what's coming your way. Stay informed, stay on top. We bring you every drop.
Pulse of the sales industry by Ringy. Let's get into it.
Welcome back to the Deep Dive Learner. So, you know that feeling right around the same time every year?
Oh, the dread.
Yeah, exactly. You go to the mailbox, you pull out that envelope from your auto or home insurance company, and you just, you brace yourself.
Right.
You open it up, and there it is. Another skyrocketing premium. And you might even drive past your local insurance agent's office down the street later that day and wonder why they always seem to have this permanent look of stress etched onto their face.
I definitely do.
Right. Well, today we're looking at the massive, almost entirely invisible shift that is completely rewiring that entire industry.
It is a profound structural shift, honestly. We're looking at a system where the traditional methods of buying, selling, and even just talking about coverage are fundamentally breaking down.
Which is wild.
It is. We are deep in what the industry calls a hard market. That's a period where insurers are aggressively raising premiums, they're tightening their underwriting guidelines, and restricting who they will even offer coverage to. And the local agents, they are caught right in the middle.
So to understand what is actually happening behind the scenes of your policy, we are pulling from two very different sources today. First, we have this structural blueprint of how these agencies operate day to day. We're looking at the organizational framework of the Ringy Help Center,
Right.
which gives us a window into the tools agents use, categories like leads, SMS, and sales pipelines. It is essentially the ideal architecture of how an agency is, supposed to function.
That is the theory, yes. A clean, organized system where data just flows smoothly from prospect to a closed sale.
But then we pair that ideal blueprint with a serious reality check. We have a highly detailed 2026 research report from Metricus titled Insurance Agent Pain Points 2026, Leads, Retention, and the Hard Market.
A very telling title.
Seriously. So the mission of our deep dive today is to take these two sources, uncover the hidden operational pressures squeezing local agents right now, and reveal how a brand new AI pre-sale research layer is quietly dictating how you, the consumer, end up buying your coverage. Okay, let's unpack this. And let's start right at the top of the funnel.
The top of the funnel is where the disconnect between the software's ideal flow and the market's actual reality is just, well, it's the most glaring. If you look at those Ringy operational categories, it implies a very orderly process.
Yeah.
You have a bucket for leads, a bucket for your sales pipeline, and communication tools. You buy a lead, you put it in the pipeline, you dial the number, you make a sale.
Assuming everything works.
Exactly. It assumes the input, the lead itself, is valid.
And when you dive into the raw data from 2026, you realize that pristine software pipeline is being pumped full of absolute garbage. The research shows that agents rely incredibly heavily on third-party lead aggregators just to keep their pipelines full. But the quality of those leads has totally collapsed. We are talking about a threshold where over 50% of leads coming from these aggregator channels are completely bogus.
Over half. I mean, think about that. It alters the fundamental math of running a local business. There is a quote in the data from an agency owner who points out that a few years ago, maybe 20% of their leads were bad.
Which is annoying, but manageable.
Right. It's an annoyance. You factor it into your budget and you move on. But hitting that 50% mark of fraudulent or dead-end leads, that paralyzes the entire operation.
So what is the actual mechanism driving this fraud? I mean, are these just bots filling out online forms, or are companies legally scraping and selling data multiple times over?
It's actually a combination of both, driven by the fact that the barrier to entry for setting up a fake, quote, comparison site is virtually zero right now. Automated bots are flooding these lead generation forms using stolen or synthetic identities. And at the same time, the aggregators themselves are engaging in aggressive recycling. An agent will pay thousands of dollars for a batch of leads, only to realize the aggregator is selling them the exact same names and phone numbers they already purchased a year prior.
Oh, that is so rough. But that makes total sense. Think of it like going to the grocery store and paying a premium price for a dozen eggs. But when you get home and open the carton, 6 of the eggs are just empty shells, and the other 6 expired last year.
That is a perfect way to put it.
You are paying top dollar for the whole dozen, but your return on investment is entirely negative.
That egg carton analogy illustrates the daily frustration perfectly. And the financial metrics, well, they validate it completely. The standard cost to acquire a new customer in this industry sits anywhere between $150 to $400.
Okay.
Now, if an agent gets an inbound call transfer, meaning a verified human who is actively looking for insurance is patched directly to their phone, they can close that sale roughly 25 to 33% of the time. The unit economics work in that scenario.
Right, because it's a real person.
Yeah.
But the shared or aged leads, the cartons full of empty shells, those paint a completely different picture.
They absolutely do. For those shared aggregator leads, the close rate has standardized at a miserable 2 to 3%.
2 to 3%, that's nothing.
It's nothing. An agent simply cannot build a stable, functioning business when they have to dial 100 numbers just to find 2 viable prospects. Especially when the fraud patterns in these networks are running this high. The margin for error has completely vanished.
So let's say they manage to pull off a miracle. The agent wades through the empty shells, avoids the bots, and actually gets a real person on the phone. You would think the hard part is over.
You would.
But the data shows they are walking straight into an internal war. They are fighting the very companies they represent, and they are pitching to a consumer base that is obsessively focused on one metric.
Price. Yeah, and this dynamic raises an important question about the modern structure of the insurance market. To understand the tension, we have to look at the market share. According to the Big I, which is the Independent Insurance Agents and Brokers of America, independent agents are still the heavyweights in the industry.
Okay.
As of their 2025 market share report, independent agents place 61.5% of all U.S. property and casualty premium. They are physically moving the vast majority of the money.
But the huge caveat there is that they are increasingly competing directly against the direct-to-consumer digital arms of their own carrier partners. Like Progressive is used as a prime case study here.
Yes, exactly.
In the first quarter of 2025, Progressive's direct auto channel, the side where consumers just buy on the website, that grew by 25%. But their agency auto channel, which is driven by tens of thousands of local independent agents, only grew by 18%.
The writing is on the wall there.
Right. The direct digital channel is clearly cannibalizing the traditional agency channel.
And consumer behavior is accelerating this shift. TransUnion data indicates that 47.1% of auto policies were shopped at least once in the past year. Nearly half the market is actively looking for a cheaper option.
Wow.
So when an agent finally gets that rare, valid prospect on the phone, the conversation is entirely one-dimensional. The consumer is conditioned to only ask, who is the absolute cheapest?
And as a consumer, I have to challenge this model. If I can pull out my phone, go straight to Progressive or Geico's website, bypass the local agent entirely, and get a cheaper price, why shouldn't I?
It's a fair question.
I mean, what is the actual point of an agent in 2026 if they can't beat the algorithm's price?
What's fascinating here is that the online quote you get directly from the carrier's website is frequently an illusion.
Really?
It is a highly engineered, deeply flawed representation of what you are actually buying, and exposing that flaw is exactly where the local agent has to build their defensive moat.
Let's drill into that. How is the quote an illusion? Are they just like stripping away essential coverage to make the bottom line number look unbeatable to the algorithm?
That is precisely what is happening. The research points to massive limitations and transparency gaps in direct-to-consumer online quoting tools. They quote a 53-year industry veteran who went onto a major direct carrier site just to test it out.
Okay.
And even with over half a century of professional underwriting experience, this veteran could not find the details regarding physical damage coverage on the quote. The interface completely obscured the actual terms of the contract.
That is a huge blind spot. I mean, if an industry veteran cannot spot the coverage gap in the fine print, the average person clicking buy on their phone while waiting in line for coffee has absolutely no chance.
None whatsoever. The J.D. Power 2025 U.S. Insurance Digital Experience Study puts hard numbers to this frustration. They found an 86-point satisfaction gap between the top and bottom insurers, specifically regarding their quoting functions.
That's massive.
Right. The very digital tool that is supposed to be the direct carrier's biggest advantage, getting a seamless online quote, is actually where consumers are experiencing the highest friction. They just don't understand what they are buying.
This directly feeds into what the research calls the $150 versus $200 objection. An agent will get a client on the phone, and the client will say, look, I just went online, and the direct quote said, my premium would be $150. You are quoting me $200. I'm going with the website.
That is the daily reality for these agents. But what the online interface intentionally downplays is that the $150 price tag is often a hollowed-out policy.
Right.
It might lack the physical damage component, or it carries deductibles so high they're practically useless.
Yeah, and we all know that teaser rate is going to shift once the carrier actually pulls a motor vehicle record or runs a comprehensive underwriting report. But the average consumer doesn't realize that the price isn't locked in until the final bill actually arrives.
Spot on. The final adjusted price is rarely the initial online teaser rate. So the local agents absolutely cannot win a pure price war against a website designed to show the lowest possible number.
So they win the translation battle.
Exactly. Their actual value is acting as a translator and a shield. They protect you from confusing terms, stripped-down policies, and hidden gaps in coverage that will financially ruin a family if they actually get into a major accident.
They have to shift the conversation entirely from price to protection. But here is the brutal part. Even when an agent successfully wins that translation battle and secures the client, they face an entirely new gauntlet just trying to keep them. Winning a client is an incredibly short-lived victory in this environment.
Because client acquisition is no longer the main hurdle, retention is. The hard market is forcing these agents to deliver terrible financial news to their own clients year after year.
Yeah, the cumulative premium increases mapped out over the last 3 years are just staggering. We saw an 11.6% average rise in 2023.
Unprecedented at the time.
Right, and that was followed by a massive 18% spike in 2024. And on top of all that compounding cost, another 8.5% increase in 2025.
That is a 24% cumulative premium rise over just 36 months. That is a massive compounding hit to a normal family's budget.
And what is driving that? Is it just corporate greed, or is it the underlying cost of claims?
It is deeply tied to the macroeconomy. Supply chain disruptions have made car parts exponentially more expensive. The technology inside a modern bumper makes a fender bender cost thousands of dollars to fix.
Oh, sure, all the sensors and cameras.
Exactly. Combine that with inflation and catastrophic weather events driving up home repair costs, and the carriers are bleeding capital. Their only lever to survive is to drastically raise rates.
And the fallout on the consumer side is entirely predictable. According to J.D. Power, 43% of homeowners who experience these rate increases state they will not renew with their current insurer. Almost half the market is ready to pack up and leave out of pure frustration.
And the person who has to deliver that news, the person catching all that frustration, is the local agent. They're the messenger getting shot on a daily basis. The burnout metrics in the research are alarming.
I can imagine.
Currently, 51% of independent agency employees report feeling burned out. Industry-wide turnover has spiked between 12 and 15%.
And clients are completely losing their patience, too. The 2025 Zyway Broker Services Survey found that a staggering 82% of employers would drop their broker simply over slow response times.
The tolerance for any delay has hit absolute zero. The research highlights a specific compliance risk in California.
Oh, right.
Non-responsiveness from an agent or broker isn't just viewed as bad customer service out there anymore. It is so severe that under the California Insurance Code, a pattern of non-communication can actually trigger a formal market conduct violation.
Wait, really? You can be penalized by the state for not answering the phone fast enough?
You absolutely can.
So what does this all mean? Are agents just getting complacent? Or is the infrastructure of these local offices just collapsing under the sheer volume of these rate hike conversations?
It is the infrastructure collapsing under the emotional and operational labor. Think about the workflow. An agent has to explain a 24% hike to a client. The client demands they shop the policy around.
Right.
The agent spends hours remarketing the account to 5 different carriers, only to find out that the original 24% increase is still the cheapest option available. They do all that work just to retain an angry client. It is exhausting.
Which means the retention game has completely changed. You can't just wait for the phone to ring.
It must be fiercely proactive. The data shows successful agencies are surviving by adopting strict contact windows, specifically a 120-day look-ahead and a 90-day proactive contact window before a policy renews.
You have to beat them to the punch.
The harsh reality of 2026 is that if the client is already researching alternatives online before the agent calls them to explain the rate hike, the agent has already lost the account.
So agents are working twice as hard just to keep angry clients, which leaves them with zero time or budget to fight the direct carriers on traditional battlegrounds. And we have to talk about those battlegrounds because the ad budgets are just mind-boggling.
They really are.
Progressive's 2024 ad spend hit a record $3.5 billion. Geico's 2025 outlay is projected at near $1.9 billion. A local agent on Main Street cannot buy enough billboard space or local TV spots to compete with $3.5 billion.
They absolutely cannot. It is an asymmetrical war if fought with traditional advertising. But the battlefield itself has moved. The solution for the local agent lies in dominating a completely different space, the new AI pre-sale research layer.
Oh, this is cool.
And this layer is no longer controlled by traditional search engine algorithms.
Here's where it gets really interesting. The research reveals that buyers are no longer just typing car insurance near me into a search bar and clicking the first blue link.
No.
They're having conversations with AI platforms. They're asking large language models, who is the most reliable local broker in my zip code?
Yeah.
Or which auto carrier actually pays their physical damage claims without a fight?
The consumer is crowdsourcing their research to an artificial intelligence before the agent ever even knows a prospect exists. If we connect this to the bigger picture, the AI is the new ultimate gatekeeper.
Yeah.
In previous years, local SEO was about keyword stuffing on a website. Today, it is about semantic understanding and reputation scoring.
Right, because how does the AI actually form those recommendations?
Yeah.
It isn't just reading the agency's website.
Exactly the opposite. To survive, agencies must understand exactly what the AI is saying about them, but more importantly, why it is saying it. Right. These AI models form their answers by crawling obscure local directories, cross-referencing hundreds of Google reviews, and pulling from third-party data aggregators to build a trust profile. If an agency has conflicting business hours on a forgotten Yelp page or unaddressed negative reviews from 3 years ago, the AI flags them as unreliable.
Which means if you aren't visible and highly credible to the AI's logic, you don't even get the chance to compete. You aren't in the consideration set. You are effectively invisible.
Yes.
The AI has already told the consumer to go somewhere else before you even had a chance to buy their lead, which we already established is probably just an empty eggshell anyway.
It ties all the operational pain points together perfectly.
Yeah.
You avoid the fraudulent aged leads by having the AI organically send high-intent buyers directly to you.
Nice.
You justify your value over the direct carrier's stripped-down online quote because the AI has already primed the consumer to view you as a trusted local expert. And you manage the retention crisis because your digital presence is constantly reinforcing your credibility, even before you make that proactive 90-day phone call. You have to fix your digital inputs so the AI outputs your name.
It is an incredible, almost overwhelming journey we've tracked for the 2026 insurance agent. I mean, they are navigating a literal minefield of bogus aggregator bots. They are battling the $3.5 billion ad spends of the very carriers they represent.
Yep.
They are absorbing the emotional trauma of explaining macroeconomic premium hikes to their neighbors. And on top of it all, they were having to become technical experts in AI visibility just to keep their phones ringing.
It is a relentless high-wire act. And for the listener, the end consumer, it is vital to understand the reality of the ecosystem you are stepping into. The next time you shop for insurance, you aren't just making a simple numerical price comparison.
Not anymore.
You are interacting with a heavily stressed, rapidly shifting hidden ecosystem. You are dealing with AI pre-qualification algorithms, direct channel conflicts, and local professionals who are fighting tooth and nail to offer you genuine value and protection in a market algorithm that just wants to sell you the thinnest policy possible.
It really makes you look differently at that premium bill in the mailbox or that local agent's office down the street. But it leaves us with one final kind of wild thought to ponder on your own. If AI is already doing the pre-sale research for us right now, crawling the directories, looking up reviews, spotting the coverage gaps,
Right.
what happens in a few years when our own personal AI assistants start independently negotiating and auto-switching our insurance policies every 6 months without us even asking?
Oh, wow.
I mean, how will a human agent ever compete when our personal AI is just talking directly to the carrier's AI? That crumpled bumper in the driveway might be easy to see, but the future of who actually negotiates the coverage for it is looking murkier than ever.
Also the sales industry. Stay ahead of the game. Latest news, latest trends. Nothing ever stays the same. Market shifting every day. Gotta know what's coming your way. Stay informed, stay on top. We bring you every drop.
Pulse of the sales industry by Ringy.